Hey everyone, and welcome back to another portfolio update for you today. So over the past week, the portfolio went up by 4.33%, whereas the S&P 500 was up 1.12%. Year to date, the portfolio is up 62.23%, whereas the S&P 500 is up 14.18%. And since the start, the portfolio is up 159%, whereas the S&P 500 is up 34.71%. And so in today's video, we're going to go over a lot of market data available for us. I also want to touch on if there is a recession or if there is a market crash coming, what are we going to do or what am I going to do specifically? So first up, let's play this clip.
I'm not going to bed every night worried about what will happen next, but markets run in cycles, and whenever we've historically had a significant acceleration in a new technology that creates a lot of capital formation and therefore lots of interesting new companies around it, you generally see the market run ahead of the potential because they're going to be winners and losers. If you go back and you think about the internet, pick on Amazon. Amazon was one of many companies that was prosecuting that kind of opportunity. Many of the companies went away. Amazon became an incredible company. You're going to see a similar phenomenon here. I wouldn't be surprised if in the next 12 to 24 months we see a drawdown with respect to equity markets, but that shouldn't be surprising given the run we've had. But generally speaking, I think what's super exciting is the technology is expanding, new companies are being formed, and the potential of this technology deployed into the enterprise can be very, very powerful. And so it's an exciting time in the market. The market looks forward.
In other words, over the next couple of days, maybe weeks or months, it might be sunny, it might be raining as well, right? We know market pullbacks happen. Heck, we had a huge one in April, right? Of course, it's you could say a self-inflicted one with the whole tariff story here. But here again, over the next 12 to 24 months, we might see the markets pull back or crash or whatnot. Okay, congratulations. If I had $1 for every time I've heard people say that the market will crash next week, next month, I'd probably be a millionaire right now. Now, that said, it's not to say that we will not experience a pullback. No, pullbacks happen, right? Over the long period of time in stock market history, there aren't that many great crashes, right? There is a reason why you can point out all or most of the times when the market experiences a huge crash, right? It's because these things don't really happen a lot of times. Most of the times, markets do go up. And that's why it's important to remember this incredible quote by my favorite investor, Peter Lynch. Far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And let's take a very recent example. Going into 2025, we've had an amazing 2023, we've had an amazing 2024, and so going into 2025, you've probably seen a lot of the headlines, right? Oh, 2025 is going to be a horrible year. We've just had 2 amazing years. Markets are at all-time highs. It's a bubble, extremely stretched. This smells like the dot-com bubble, right? These are probably things that we've been hearing for the last probably 12 months or so. And yet here we are in the month of October 2025, and we are going higher. I've shown you in the past videos that actually buying at all-time highs historically has worked out extremely well. Because guess what? 10 years ago, the markets were at all-time highs. 5 years ago, the markets were at all-time highs. And today we are also at all-time highs. You make new highs every single time. And so when we're seeing the S&P 500 go up every single month for the past 6 months, this has only happened, well, the last time it did happen was back in 2021. When we're starting to see this, when we actually look at the Nasdaq 100 after it's up for 6 months in a row, even when all of that happens, if we look at the couple of dates that we have to work with here, well, funny enough, the odds are still in our favor going forward. If we look at what happens with the market 1 week later or 3 weeks later, the amount of times that we are green, a week later, 60%. 60% of the times we're positive. 2 weeks later, 80% of the times we are positive, and we're actually up on average 3.76%. Then, if you look at 3 weeks later, a month, 2 months, 3 months, 6 months, a year later, almost all of the times we are green. Other than the 6 months later, where only 80% of the time we are green. And so, yeah, these things have happened in the past. Of course, if we look at August 31st, 2009, that's probably near the bottom of the great financial crisis. And so that's why you're seeing these amazing returns. But again, it is very important to focus more on the companies that you hold in your portfolio. And I'll show you some extra things here in a bit. First of all, you've probably seen this as well. US banks are now sitting on $395 billion in unrealized losses as of Q2 2025. People here are ringing the alarm bells, but this has been worse before, right? If you look at 2022, 23, 24, same thing there. And what has happened since? Market has gone up. Earnings have gone up. Companies has been performing very, very well. Now, yes, it's true that in October, historically, of course, like we've said with September, historically on average, September is the worst month of the year. Well, in this case, now that we're in October, well, October historically is the most volatile month of the year for stocks. Average October volatility is 33% above average for the other 11 months. So maybe October is the month where we are going to see some profit taking, some big pullbacks, some nice opportunities as well. Let's wait and see. Then on a technical basis here, the S&P 500 has now traded above its 50-day moving average for 108 consecutive trading days. This is the third longest streak going back to 1990. 95 and 2007 were longer. Of course, you will say, yeah, but 1995, we know what happened 5 years later. True, 5 years later. 2007, we know what happens just after that. Again, I'm just putting out the data out there. You can conclude whatever you want. The one sector that has been underperforming by quite a lot is the healthcare sector. So healthcare stocks are underperforming the S&P 500 by the largest margin in history. Is this going to be an opportunity going forward? Right? If everything tech, quantum, whatever, is extremely expensive, stretched, overvalued, then maybe going into 2026, the contrarian trade would be to load up maybe on healthcare stocks, defensive stocks, right? Maybe that could be the play. Because if we look at the market cap weightings in the United States, the super sectors, so tech or tech related, traditional cyclicals and defensive ones, we can see that tech is now higher than back in the dot-com bubble. Again, people will say, oh, you see, it is worse than the dot-com bubble right now. Well, I don't know about you, but today I think our lives are way more tech-related than 25 years ago. Plus, the companies today at the top are worth trillions of dollars, which, of course, much more than 25 years ago. More profitable, higher margins, fast-growing companies. So it makes sense. It makes sense that tech makes up the majority here. It makes sense. Now, as for the defensive names, okay, maybe that might be the contrarian trade, the defensive trade for 2026, is to look at hated companies, is to look at hated stocks, stocks that have not seen a huge amount of money flowing into, right? Because most of the money right now is going into tech names, AI names, right? I think that's fair to say. I own them, you own them as well. Now, all that said, this is the 14th time since 1990 where the S&P 500 was up at least 10% through September. The S&P 500 went on to finish the year higher in 12 of the 13 prior instances. So again, the odds here are in our favor in order for us to end the year again on a high. And that's the thing here. That's the thing. There is a great book out there that I'm currently reading. I'll maybe touch on it in another episode, but the title of the book is Just Keep Buying. And throughout the book, the author talks about, well, and shows you a lot of data. What happens when you buy all at once? What happens when you average in? Well, guess what? The data shows that On average, over a long period of time, buying all at once outperforms averaging in, right? It's quite crazy, right? We always thought that dollar cost average is the best thing out there. Dollar cost average is outperforming the putting everything all at once when markets are pulling back, when markets are crashing. Why is that? Very simple, right? Because if you put everything all at once, let's say on Monday, and then the market starts crashing on Tuesday, you've got no money left. But if you are averaging down or dollar cost averaging, right, on Monday, then next Monday, then the Monday after that, then you are, of course, buying when the markets go down at lower prices consistently. But then again, if we go and look at the other scenario, if the market has crashed, let's say we are in 2009 right now, and you put everything all at once at the bottom or near the bottom, you will, of course, outperform the person that will start putting money every week or every month because he's going to buy at higher prices consistently while you've, in this case, successfully managed to time the bottom or at least buy all at once near a bottom. But again, it's important to understand, I'm not saying here that you should try to time the market. No, you should keep buying. That's the thing. You should keep buying because the data backs it up. It is very, very difficult emotionally to follow this plan. I fail at it sometimes. You fail at it, of course, as well, right? We all fail at it because emotionally, sometimes it is difficult. It is difficult to average up. It is difficult to buy stocks when the markets are at all-time highs. We rather buy it when the markets are extremely low, when things have crashed, right? But the data shows that over a long period of time, the strategy is to just keep buying. Of course, you have to keep buying great companies. But since most of us have portfolios with numerous stocks in them, even if, let's say you have 10 stocks, even if 2 of those 10 are losers, you have 8 winners that will, of course, outperform the losers. Because the loser, worst case scenario, goes to zero. Of course, on the way to zero, you will probably sell it. Winners can go up more than the losers, right? A loser goes down to zero, you lost 100%. A winner can go up 100%, can go up 120, 150, 200, 300% over a long period of time. And so when we have 2 consecutive bullish years, now maybe 3 consecutive ones, of course, we start asking the questions. What happens next? What happens in 2026? Well, honestly, nobody knows. Nobody knows. Everyone's trying to say that they might think that they know that something you don't know. Okay? If you did know, you'd probably be very, very rich. But we don't know. Just like people have been telling us that there is a huge, huge market correction and biggest recession ever coming for the last God knows how many years, didn't happen. It didn't happen. But in the meantime, we've had pullbacks. In the meantime, we've had crashes. Right? People forget that stocks, the stocks that you're seeing here on the screen, have gone down significantly in 2025 over a very short period of time. Right? I've shown in past videos. Nebius, Iron, the Nvidias, SoFi, they went down 30%, even more already this year. People forget it. But we've had a huge short crash, flash crashes. And flash crashes have happened quite a lot actually over the last couple of years. But of course, when you are heavy in tech, you are outperforming the market quite significantly, especially over the last 3 years. And so you might start to think, maybe 2026 is the year where things go wrong. Well, first of all, you can do what every smart investor does, and that's take some profits. Right? This is what I've been doing as well. I've taken some profits from Micron 2 weeks ago. I've taken some profits from Alibaba as well over the past week. Sold 30 shares or 23% of the position for a 109.4% gain. Very simple. Taking profits to increase the cash position. Alibaba has more than doubled for me since opening up the position. So for me, it makes sense. Alibaba is still here now, 5% of the portfolio. And so with taking profits, you are securing your gains. Right? The gains are now, the cash pile here is now a safety net. If we do have that big pullback, I'm ready to increase those positions, I'm ready to attack. No problem. Right now you might say, yeah, but look at the other stocks. You're up quite a lot on all of the other names here as well. Well, first of all, thank you very much. But you are up as well, because if you've been watching the channel and I've been reading all of your comments, most of you are up significantly this year, so congratulations. But yeah, there are some positions here where I don't feel the need to take profits. SoFi, I don't feel the need to take profits. I actually don't mind adding at these prices. And again, yeah, averaging up. Nebius, averaging up. Okay, maybe not at this price right now because my average is very, very low. Plus, I'm in no rush to continue to add a lot more. But any big pullback, I will of course be adding. Google, still cheap in my eyes, but it is the number 3 position in the portfolio. Rocket Lab, all-time highs, right? I've added along the way. Of course, I also took some profits at $51 back in June or July. Since then, I've been accumulating the shares that I've sold. Okay, with Rocket Lab, we also know that we have a huge event coming up. Neutron, a crash there or something delayed or something that doesn't work, you can definitely see this stock being hit quite a lot. That's fine. I'll accumulate more. D-Local, still cheap in my opinion. And I did buy a bit more of D-Local, increase the position by just 5.1%, slowly accumulating more shares. It's now at 5.71% here of the portfolio. Then we've got Micron, as I've said, taken some profits, and it's still a decent size here. Then we've got AMD, Alibaba, Uber, Duolingo, only down 6.1% right now. It did recover nicely. And by the way, with regards to Google, we did have some data from SimilarWeb. And so 12 months ago, ChatGPT's share was at 87.1%, Gemini at 6.5%. Today, ChatGPT sits at 73.8% and Gemini 13.7%. So Gemini more than doubled over the past 12 months. As for the rest, Meta still doing very well. Oscar back above $20, and it does seem like the experiment with Jose is working. So we're back here, $21.66. PayPal, of course, I will go over my options in a bit. Then we have Rubrik, up 2.6% since initiating a position. It's still very small. Rubrik and Shift4, I will accumulate more shares, of course, accordingly. Then United Health, you could say this is my defensive play. Maybe I should be increasing that position a little bit more, especially going into 2026. And then we've got Upsellera, very small position. Nvidia, 3 shares there, and 1 of Palantir. As for the options, as you can see, they are doing very well. Well, much better than last week. The PayPal ones are all in the green. Finally, they're all well in the green. And Face is still in the red. And Intel is, of course, also very well in the green, up 473% on that. But as you know, I did sell half of those options 2 weeks or so ago. Yes, could have made more money, but here again, securing profits and putting that money to use because I did open a position in Rubrik and Shift4 with that cash. But the rest here still the same. As for CoreWeave, maybe I'll put myself here. As for CoreWeave, didn't add more shares more recently, still 204.18 shares at $96, so that's doing quite well. With Iron, I did buy 100 extra shares, so now as a total, I do have 1,000 shares of Iron at an average of $22.55. So here as well, doing extremely well, and I'll probably accumulate more shares over time. Of course, I will be averaging up. And as for BMNR, I still have 169 shares of BMNR, and I'm not going to add more money to that position because, again, to me, it is a very, very speculative play. It's way more speculative than, of course, CoreWeave or Iron, or even when I had Applied Digital. I know it gets a lot of attention nowadays, BMNR, right? Because Ethereum goes up and there is quite a lot of momentum with tokenization of assets and all of that. But to me, it still is a very, very speculative play. And that's why it's only 169 shares. Now, last thing here, quite interesting because we do talk a lot about AI and data centers and all of that. According to Bloomberg, power demand from AI data centers should quadruple in the next 10 years. So AI data centers are set to consume 1,600 terawatt hours of power demand by 2035, equal to 4.4% of the global electricity, with China and the United States basically being half of those. Where's that electricity going to come from? Remains to be seen. And so, all in all, to conclude, the message here is quite clear. Don't get scared out of your positions. Of course, everyone is in a different situation right now, right? Some people have a lot of cash, some people have a lot of cash flows, which means that no matter what will happen, they'll find cash in order to invest and dollar cost average. Some others are fully invested and do not have the luxury to add more cash into the future. And of course, the strategy there is going to be a bit different. And so that's why I keep saying nobody got poor by taking profits. If you want to have exposure to all the names that you hold today, but want to be more defensive going into 2026, just take a little bit of profits, secure those profits, increase your cash pile if you want to, and then if there is a pullback, at least you'll sleep well at night because you know you'll have cash to deploy. But if we purely go back and look at the data historically, just keep buying. Just keep buying. Don't try to time the market. Just spend more time in the market. That's about it for me in this video. If you enjoyed, see you all in the next one. Bye bye.